Thank you very much for waiting. We will start the IASB seminar, IFRS 18, Presentation and Disclosure in Financial Statements. First of all, may I invite the Chair of the Accounting Standard Board of Japan and the Sustainability Standard Board of Japan, Mr. Yasunobu Kawanishi, to welcome you all. Hello, everybody. Thank you for the introduction. I am Kawanishi, Chair of ASBJ. Together with a co-organizer, on behalf of FASF, I would like to welcome you all. First of all, thank you very much for joining us despite your busy schedule. I take this opportunity for your everyday cooperation with the activities of the FASF Foundation and ASBJ. With the support of JICPA, we have a board member, Mr. Nick Anderson of ISB's visit to Japan. And by the invitation of JICPA, we are able to co-organize this program. Chairman and President Mr. Mogi, to all of the members of the JICPA, I thank you all very much for this kind cooperation and excellent opportunity. Today's topic is IFRS 18 and its application. As you may know, it was released in April, effective from 2027, mandatory from January 2027. As for the specifics, of course, there will be presentation from the ISB. According to my understanding, presentation, and in particular, the profit and loss statement, income statement, may change significantly. What portion will change in what way, or what are the reasons for the changes? There will be detailed presentation which we are looking forward to, so please do stay with us for the full program. At FASF from 2017, we have made an international human resources network so that we can organize seminar and send out information on a global basis. From last year, not only for accounting human resources, but also for sustainability human resources, we are working on this human resources networking. And this is also the 10th symposium in a series of our activities to cultivate global human resources. I hope that today's seminar will contribute to your better understanding about IFRS 18. Once again, thank you very much indeed. Thank you very much, Chairman Kawanishi. Now we will go on to the next part of the program. The first speech will be by Mr. Nick Anderson, a board member of IASB. He will discuss about the IFRS 18 presentation, disclosure, a financial statement. Please welcome him.
Good afternoon, everyone. Thank you for those kind words of introduction, and also my thanks to JICPA for helping to facilitate my visit to Japan and this event. It's fantastic to see so many of you in the room as we talk about IFRS 18. So to begin with, to give you an overview of the new standard, a high-level view, IFRS 18 arises from our work on primary financial statements, the ISB's project on primary financial statements, and it responds to investors' demands for better information about companies' financial performance. It will improve how information is communicated in the financial statements and gives investors a better basis for analysing and comparing companies. It will affect all IFRS accounting standards, the whole ecosystem. It will touch all companies, albeit to different degrees. So there are three main sets of requirements in IFRS 18. Just to touch on those briefly. First of all, there will be a new structure for the statement of financial performance, and that will help investors compare performance between companies by requiring them to present two new defined subtotals, including a new defined subtotal for operating profit. The second set of requirements relates to disclosures about company-specific measures of performance, and we call those management-defined performance measures. And those will be required to disclose in a single note to the financial statements. And the third area of requirements enhances the guidance around grouping of information, of what we call technically aggregation and disaggregation. And collectively, those requirements will help provide better information for investors so they make better investment decisions. The effective date is the 1st of January 2027, and in a moment my colleague Rika Suzuki will talk about implementation and transition to the effective date. So let's concentrate on the first set of requirements around categories and subtotals. So put yourself in the position of an investor, particularly one, a portfolio manager or analyst that works in an asset manager, often following a large universe of stocks, often operating on an international or global basis. Each time they come to a new company, the first thing they often have to do is work out how the statement of profit or loss works, or as I say, solve the P&L puzzle. We will alleviate that need through bringing more structure, a more consistent and comparable structure to the statement of financial performance, through the introduction of two new subtotals and three new categories. Operating profit will be one of those subtotals. It's a term that's commonly used and defined in some jurisdictions today. But as we look globally, and indeed we spent time looking at a sample of 100 companies, we found almost 2/3 of those companies use an operating profit type subtotal. Within those companies that provided that subtotal, we found at least 9 different definitions of operating profit. Not particularly helpful from comparability. So what you see now on the slide in front of you shows the structure of the P&L for a general corporate under IFRS 18. And this is for a company that predominantly reports by function. It could be one that reports by nature, but this one predominantly reports by function. We'll look at other companies later on that either provide finance to customers or invest in activities, invest in assets as a main business activity. And you'll see a slightly different structure for those companies, but this is for a general corporate. And here, those new subtotals of operating profit and profit before financing and income tax help provide that structure. They provide the lines separating the categories from operating, investing, and financing. So the strategies which are marked out in dark blue and bold shading, those will be required IFRS subtotals, and to complement them are some specified subtotals that have been defined by under IFRS, such as gross profit, which can be used if they help provide a useful structured summary in terms of the P&L. So this is our overall structure for the P&L. So every time I come to that P&L now, I will no longer have to solve that first puzzle. I will know how that fits together. I will have that vision. I'll have that consistent structure. I will have what I call a map in my mind. I will know that structure. And that becomes very important in a world where digital financial reporting becomes the norm. Those items are often unstructured, or they're described as unstructured. I have a list of items and I have to work out how they fit together to form the P&L. Under IFRS 18, I will know how they'll fit together. I know which section of the P&L they will fit in. I know whether they're within operating profit or whether they fall beneath that, where they form a component of profit before financing and tax, I will have that picture in my mind straight away. And that's a huge improvement for investors. That leads to an improvement in comparability for investors. If I think back over my 3 decades in the asset management industry, there were 2 big changes in financial reporting that stick in my mind. One was the increased adoption of IFRS, but the second was more on the business side of asset management, which was the movement to more international and global mandates. That's what our clients demanded. Increasingly, asset managers, fund managers, and analysts are being asked to make comparisons on an international, if not global basis. And by having a consistent structure for the statement of profit and loss helps facilitate improved comparability. The structure we have will also aid investors in their forecast. Investors, by their very nature, are forward-looking. They seek to forecast both cash flows and profits. They forecast other items as well, but those will be the focus. And here the structure we have, again, provides that clarity. They know what will be within their margin calculations for operating margins as they forecast forward. So very important for them to have that structure. And as I highlighted, these new requirements respond directly to what we've heard from investors around the world in terms of improvements we could make. So that's the first set of requirements. The second set, which I think of as being complementary to providing more structure to the statement of profit and loss, are around what we call management-defined performance measures. These are company-specific measures of performance. So we've eliminated some of the flexibility in the structure of the profit and loss statement, but it's still absolutely crucial that companies have the ability to tell their story through the use of company-specific measures of performance. And so we need to facilitate that, and we need to ensure that provision of those numbers is enhanced alongside a more structured P&L. And we've done that through the introduction of management-defined performance measures, MPMs for short. These are subtotals of income and expenses used by management in public communications to portray the performance of companies. So focus on the statement of performance. These investors tell us consistently are useful in their understanding of companies. They're useful in understanding how companies want to portray their performance. They're useful for investors in monitoring that performance. But sometimes the construction of those measures has lacked transparency. So IFRS 18 introduces a number of disclosure requirements to help enhance that transparency. The first thing it does is very basic, but it's important to investors. It asks for all this information to be provided in a single note to the financial statements. Today, when investors look for this information, they find it scattered. Sometimes it might be in the financial statements for some companies in some jurisdictions. Sometimes it might be in the management commentary. Sometimes it's just in the press release. Sometimes you might find it in an analyst's presentation pack, but you don't really know where to find it. Going forward, this information, as I say, will be always in a consistent place in a single note to the financial statements. Now, within that note will be a number of things which will be important. So the first one is a reconciliation back from the management-defined performance measure to an IFRS-defined subtotal. So it provides that linkage between IFRS and between the company-specific measure of performance. And that reconciliation provides transparency to investors in terms of what is included in the company-specific measure of performance and how different it is from the IFRS-defined measure. So IFRS may provide you with an operating profit number. The company may have an adjusted operating profit number. And it's the structure of the P&L, which I talked about at the beginning, that provides the anchor for that reconciliation. The other things included in that note will be an explanation of why management consider this particular specific MPMs to be a measure of their performance. Details of how the MPM is calculated, again, more transparency, And when the MPM is changed, an explanation of those changes. So we think this is very important. We think it's absolutely crucial that companies have the ability to tell their own story, to communicate. Ultimately, financial reporting is all about communication between companies and between investors. And investors want to understand how companies think about their performance, and they want to see those numbers portrayed. So the key thing for us in terms of MPMs is enhancing the transparency of those measures. And that will increase investors' understanding of those measures and the relationship between those measures and those subtotals which are defined by IFRS standards. And I think it will really enhance the communication between companies and investors. And that helps to further enhance trust in that relationship and a way of communicating performance. So as I say, complementary to that first set of measures about bringing more definition and further enhancing that dialogue between investors and companies. The third set of measures is around what we call the grouping of information. Technically, we've referred to this as aggregation and disaggregation. And what we heard from investors were concerns in a couple of respects. Some companies don't provide enough detailed information about particular aspects of their businesses. And then about other aspects of their businesses, sometimes investors feel overwhelmed about the level of information that is provided. So the series of measures around aggregation and disaggregation tackle those concerns in a number of different ways. And the first way is some high-level principles around what information should be in the primary financial statements and what information should be in the notes. And to really step back and think about what works best for companies in terms of telling their story, again, in terms of deciding what should be in what we call primary financial statements and what should be disclosed elsewhere. I think the important thing about that first set of that we'll describe as guidance on this, much of what I've talked about already is really about the statement of profit and loss. And one thing I think we want to emphasize is the principles here around aggregation and disaggregation apply to the entirety of the financial statements. And you need to think about this beyond the statement of profit and loss. I also think this is a good opportunity as companies implement the new requirements to step back and think carefully about what information is best presented on the face of the P&L, the balance sheet and the cash flow statement, what information is better disclosed in the notes. And Ryan will talk about that in further detail later on. The second area in terms of this set of requirements is around the use of the word other. And when we speak to investors about this is a source of significant frustration. And often investors feel that they have, we would have the phrase, have their fingers burnt. They have been caught out by the use of other from time to time. Not by all companies, but by some companies. And it's the experience of those companies that by the some that sticks in their mind. And so what we ask for is some considerations, some principles and guidance about when to use the word other. To think about, can you use a more meaningful description rather than simply using other? Just to ensure that there's a fuller portrayal. And actually, if other is the only word that you can use, to try and provide some further insights as to what is included in that other category, to provide comfort for investors that these are generally immaterial amounts rather than something tucked away in other that they might be worried about. So that's very important for investors. Again, it's a soft issue. It's one that requires some thought and, again, a chance to step back as IFRS 18 is implemented by companies to think about, is there a better way of describing things that have previously been described as other? The third area within this particular set of aggregation and disaggregation measures is around requirements for presenting and disclosing operating profits, and specifically for those companies that report by function, requirements to disclose specific items, operating expenses by nature, in addition to those presented by function. And this responds again, as all of the requirements do, to a request from investors to understand more about operating expenses by nature. But equally, it reflects the conversation that we have had with our stakeholders, with not only investors, but with representatives of companies, of auditors and regulators to get to this place. Because actually investors, for this particular set of information, would like to have had a fuller set of information. But ultimately in our work, we have to weigh up costs and benefits. And here we found a compromise that just asks for 5 but specific items of operating expenses by nature when companies report by function. And again, Ryan will talk about those in further detail in a moment. So the new guidance here on around aggregation and disaggregation is an opportunity for companies to think about how they both present and disclose information. As I say, an opportunity to step back and think about that. It will again enhance transparency, and I think has the opportunity to significantly enhance the usefulness of information for investors. We sometimes forget about this third aspect. Personally, I think it's one of the hidden gems within the standard, and I hope it's implemented with thought and delivers the information that we think it can and the help that it can bring to capital markets in their understanding of individual companies. So with that, I'm going to pass over to my colleague who will talk, Rika Suzuki, who will talk about the application of IFRS 18. Thank you.
Thank you very much. Now I would like to give the floor to Ms. Rika Suzuki, ISB member, to discuss application of IFRS 18 in Japan. Please join me in welcoming her with a big round of applause. Hi, everyone. Thank you very much for coming despite your very busy schedules. Thank you very much for your time. I'm very much appreciative of your interest in our new standard, IFRS 18. I would like to discuss application of IFRS 18 in Japan. Thank you very much again for joining us. And I would like to take this opportunity to thank JICPA and FASF for organizing this seminar. Thank you very much for your support. On a personal note, since July 1919, I have been serving as the ISB member, 2019, July. And yesterday, my first term did expire just yesterday. And I will be starting my second term just today. And for me, this is a memorable day. And on this memorable day, this is something special that I was given this opportunity to discuss the new standard, which was just published in April this year. I'm very much appreciative for this opportunity, but I would like to also thank all the stakeholders for extending to me a significant amount of support over the past 5 years. I'll be serving as the ISB member for the next 5 years. You may say that 5 years is a long period, but I hope that you will extend to me a continued support for the next 5-year term. Now, Nick has already given the overview of IFRS 18, a new standard, and for my part, I would like to discuss what implications the application of IFRS 18 could have. IFRS 18 will come into force on the 1st of January 2027. For those Japanese companies that are closing books in March, the year starting on the 1st of April 2027, ending 31st of March 2028 will be the first accounting year for which IFRS 18 will be applied. Discussed how much time will be required to apply the new standard in setting the effective date. Companies have been introducing IFRS standards over the years. Consultants that have been supporting Japanese companies to introduce IFRSs and auditing firms and preparers, their input has been quite valuable in coming to a conclusion that we should start applying IFRS 18 on the 1st of January 2027. This standard, we spent significant amount of years developing this standard, and the users and preparers may want to apply IFRS 18 starting in 2026. I know there are strong views amongst preparers and users of financial statements that IFRS 18 should come into force in 2026. However, we believe that it's important for the preparers to have ample time for the preparation of IFRS 18, and that is the reason why we decided to make IFRS 18 effective on the 1st of January 2027. Of course, the application is permitted. I know that many companies will be working towards the application of IFRS 18 in fiscal 2027, but 2027, you may think is further down the road. You have ample time. You think you have ample time, but it's quite close. Time flies. So I hope you will get started with the preparation for the implementation of IFRS 18. And that is one of the reasons why we are having this seminar.
This standard retrospective application is required, and in the interim financial statements, retrospective application is required, and therefore during your presentation, if you prepare for the year end, there is a risk that the time would not be enough. Some specific application-related aspects in the first year, the immediate prior year, about the comparative periods, the comparative line items will be required, and that will have to be kept in mind. As for the substance, for the interim statements, the same reconciliation item will be required in the reconciliation. So please keep this in mind as well. As Nick mentioned, these are the main requirements. What kind of changes are expected are summarized. Impact analysis, there is a separate documentation that has been published when the standard was released. So that is also helpful for all of you. And in the basis of conclusion, the expected impact, the background in the deliberation, such information are also made public. So if you could refer to such other publication as well. About what I'm going to talk now, about the transition impact, of course, it varies depending on the reporting entity, because you are preparing IAS 1 for your financial statement, and what line items you have at this moment, and what is the amount, degree of your interim reporting at this moment within your company system, what assumptions are factored in your IT system in terms of your group, how do you collect the accounting information in your company in the first place? Of course, it all depends on the company, and therefore the complexity or whether it is not too difficult to change, all those could be different impact regarding your organizations. And first of all, about the so-called revenue and expenses, and to group into categories and determine the line item and newly defined subtotals to be presented. What changes might occur? The unit of account, the chart of accounts probably will have to be changed. And with that change, the internal process, internal control, information technology changes also might be required. And of course, the line item, the subtotal would also change. And therefore, in terms of your investor relations, all those changes also will have to be factored into your work process. And other revenues and other expenses, if there is a major number under the new standard, there must be more detailed labeling required. It calls for meaningful labeling rather than simply other. So you will have to think about that aspect as well. And the next is the management defined performance measures, your preparation to disclose MPMs. What I wish to mention first is, in your public communication with investors and other external parties, if any kind of non-GAAP measures or KPI, if you are not using any of those numbers, it's not asking you to freshly create MPMs. That is not what we are asking for. But in your external communication with investors or in your IR materials, if you are already talking about any indicators in your communication, then you will have to discuss and think whether they constitute MPMs in the first place. If you are indeed using any indicators that constitute MPM, then first of all, you will go back and check your internal control system, and either you add something or change something might be required. If there are company-specific measures that you think you might have to collect freshly, because so far, if you have not been disclosing detailed MPM, then reconciliation would be included, and therefore the relevant information, the collection inside your organization, collection from the group, that would become part of the process. And whether such information was communicated outside the financial statement, maybe the persons responsible for IR might have been using it outside the financial statement, and therefore not only working within the accounting department, but with public relations or IR department or the senior management. They are also engaged in communication, and therefore there must be collaboration with all relevant department, division, offices within the reporting entity. Another point which I think I must mention, what is required under IFRS 18, you might be disclosing different subtotals, and then you might have to think hard whether you will decide to continue to disclose that different subtotals. So far, according to the feedback we heard from the investors tell us that if there is a new information, that they would positively look at those new numbers, and therefore, during the transition, careful explanation of any changes you have made is important, but using the old information and preparing two different sets in your communication with the investors, please confirm whether making double reporting might be useful. That is what you would like to check with your investors. And the next is about the grouping of information. Under the new standard, the primary financial statement and the note, the roles of those have been reviewed, and the application guidance also specifies the role. Under IAS 1, it may not have been as clear, but now I think we can say that it has become clearer. But on the other hand, with this application guidance, once again, the existing accounting policies or rules might have to be reviewed once again. And therefore, there could be various line items or different ways of aggregation or disaggregation you may have to review within your company. And once again, what are the labelings? How are they called? Regarding the naming, the labeling, most likely you will have to review those names. Last week, when there was an IFRS conference, there was some mention about this new standard. One investor mentioned that during the analysis of the financial statement, others, what does this other include? That makes me nervous. That was one comment by an investor. Based on my audit experiences and for the reporting entities, others, what are in those others? Of course, the companies are confident that you have checked and included in the others, but for the investors, they do not know what exactly is in those others. That is the human sensitivity. So I hope that you will keep that in mind.
Lastly, I would like to discuss overall impact. When transitioning to IFRS or introducing IFRS 15 revenue recognition, we'll recall that impact of application of a new standard are not limited to the numbers on the financial statements, but implications and impact could be pervasive. For example, the way you decide the management remunerations, compensations, the way you set targets for employees' bonuses, debt contract, covenants, you may have to revisit. So new standard could have significant implications, pervasive implications. So not just the accounting department, but you may want to have broader communications within an organization so that you have collaboration and cooperation within your organization to analyze the potential impact of a new standard. So January 1st, 2027 is not that far away. It could be said that that deadline is just around the corner. So we at IASB will continue to support all of you while you're getting ready for IFRS 18. Having said that, once again, I'm very much appreciative that they have given us this time. Thank you. Thank you. That was Ms. Erika Suzuki. Please. Thank you. So without further ado, we would like to move on to a workshop. The theme is Deep Dive into IFRS 18 Requirements. Let me once again introduce our speakers. Please join me in welcoming them with a big round of applause. Ms. Rika Suzuki, ISB member. Mr. Nick Anderson, ISB member. And Ms. Ruan Hasegawa, IASB technical staff. So I will have Ms. Suzuki to lead our discussion. Hello, I'm Rika Suzuki, ISB member. Thank you very much for your introduction. This is our workshop. Roan Hasegawa will serve as the MC moderator for the workshop. Over to you, Roan. This is Roan Hasegawa. At the moment, I am at the ISB Foundation on a secondment basis from KPMG Azusa. For the past decade or so, ISB has been developing IFRS 18. I included 5 were engaged in IFRS 18 development over the years. And a lot of comment letters that we received from Japan, and Japanese companies did participate in the field work. And re-deliberation on key topics. At the time of the completion of the re-deliberation, we did conduct an outreach. And during the outreach, there were a lot of input from Japan. So IFRS 18 was developed with a significant contribution by the Japanese stakeholders. So I'm very happy that we are having this workshop with the Japanese stakeholders who have contributed significantly to the development of IFRS 18. Based on the lectures and presentations by the ISB members, together with the 2 ISB members, ISE 1, what are the differences between ISB 1 and IFRS 18? And from a practical perspective, we would like to do a deep dive into IFRS 18 requirements during the workshop. The first topic we would like to cover is on categories and subtotal. There are questions here, 2 questions. First question, according to the ISB analysis, what percentage of companies applying IFRS or globally present operating profit in the statement of profit or loss? Of 100 companies were asked in issuing guidance analysis of impact, how operating profit or operating income is presented by them, to what extent globally operating income is presented by companies around the world. Please respond using the Slido.com. I think we have all the responses. Nick?
So on this one, I think the answer was 60%. So well done to those who've got it. I mean, it seems to me it's a high number. Clearly, it's a commonly used metric by companies. I think what was interesting in some of our early engagement we found some financial commentators who actually believed this was a defined term by IFRS, despite what we see in terms of diversity of that term.
Suzuki-san? Operating income could be the key as a matter of measures, not just investors, but within corporate organizations. Operating income, operating profit. Many people have been familiar with this measure. So for us in developing standards, this I believe was a very important item there.
Going on to the next Slido question, out of 100, about 60% do present operating profit, and how many different definitions were there? Can you please respond?
Nick, I mentioned this when you were speaking earlier, so I think everyone has actually been listening when we see the results.
Which is great. And I think technically what we found was at least 9, wasn't it? So say that start of that journey for investors every time they come to a company of trying to work out what's included in that key subtotal. This is illustrated by there being at least 9 different definitions.
Thank you.
Thank you. And therefore, if there are 9 definitions that would be inconvenient for the investors, according to what Nick presented, to accommodate the needs of the investors, these standards were developed. And once again, I invite Nick, for the investors, a consistent structure. Why is it necessary, please?
So I think once we have this, it's about having that map in one's mind that each time an investor comes to a company, they know there's going to be that consistency. They'll know how it fits together. They will be able to use these numbers on the basis of having enhanced comparability. So operating profit will be defined on the same basis from one company to another. But it's just really coming from that, what we saw before, having those multiple different definitions of lines like operating profit to the consistency of structure. For many years, within the work of the IASB, we have worked on providing greater comparability through focusing on recognition and measurement. But ultimately, financial statements are about communication, and then bringing this to presentation is a really significant enhancement for investors and has been very well received, I'd say, by virtually all investors that we have spoken to.
Once again, in the income statement, there are 3 new categories: operating, investment, and finance. And in between, 2 new subtotals: operating profit and profit before financing and income taxes. As is indicated on this page, additional subtotal can be presented. Earlier, as Nick mentioned, new concept will be introduced. So it will be a useful structured summary. Then that subtotal will be presented. What is on this slide? The gross profit covered in light gray. The gross profit is one example. And the grouping about the aggregation and the disaggregation, the useful structured summary will be discussed later. But this is one example of an additional subtotal. And in addition to the required new subtotals, additional subtotal can be presented. About different category, what goes in there, we will look at that for each of the category. First, the operating category is the default category, and therefore the finance and investment and the before finance and taxes, what does not go in there will be this default operating. The volatile numbers or unusual income and expenses, these are also included, and therefore all income and expenses arising from the company's operations will be included. So this can be called the default. So it comes from the income and expenses of the businesses, and it may also be others as well. The operating profit indicates as a subtotal, and the operating profit of IFRS 18, it is an indirect definition. From Japan, there was a strong request that it be defined directly. So, Ms. Suzuki, why did ISP end up with indirect definition? If you can explain, please. Thank you for the question. Within the ISP board members, initially, there was a thought seeking whether direct definition was possible. We thought, deliberated, but in order to achieve our goal, we had to conclude that direct definition was difficult. That is the first part of the background. Therefore, from many Japanese constituents, why did you not directly define? Why can you not make a direct definition? Yes, we wanted to fulfill your request. We wanted to accommodate your need, but we had to give up. It is difficult to accommodate the original achievement. Why difficult? Because at least we discovered 9 different definitions of operating profit already used in practice all over the world. And if we adopt a particular rule or regulation of a particular jurisdiction, if we select a particular business practice, if we choose to support a certain practice used in a certain industry sector, then as a result, it would not satisfy anybody. And then our goal was that when global investors look at the financial statement, the core profit, they were analyzing in their own way. The operating profit, it's not exactly that number per se, but beyond that operating profit, the investors would factor in the adjustment, and they were analyzing with their own measurement or indicator. That is what was occurring in reality. And if that number is different between different companies, then before the investors make their own performance measures, they have to analyze the performances of the reporting entities, and to analyze the financial statement without knowing what that number meant, or even if you ask questions to the companies, of course, there will be numbers that investors cannot find anywhere. And then investors will have to judge on their own. Their gut feeling or intuition or guessing had to be deployed. And then what the management thinks that the investors are using in terms of numbers, that could be different from what exactly the investors might have been referring to. And therefore, that kind of information gap, we thought, had to be dealt with, so that for the global investors across the world, if there could be a consistent starting point for their analysis, that was the goal. And without indirect definition, that fundamental goal could not be achieved. After all the years of our thought, you may feel unfortunate with the absence of direct definition, but this really could not be helped. This was our conclusion. Having said that, the operating profit that you have in mind and the operating profit according to the definition and the investors' numbers that they first look at, the same starting point is now achieved. So the start point will be the common for all, and then for the respective management, for the respective investor, you will be able to tell your own story in your own way. So at least the start point will be the same, and we hope that it will be useful.
Anything you'd like to add?
I mean, I think Rik's communicated it very well, that it's having that consistent start point, appreciating that there have been and are different definitions out there, and in a moment we'll go on to talk about MPMs and how we accommodate those.
Let me repeat that operating income is a default category, and it includes income and expense that do not belong to other categories. So let me move on to categories. Investing. There are 3 items in the investing category. Income and expenses from assets that generate a return individually and largely independently of other resources held by an entity. And incremental cost will also be included. For example, transaction cost and disposal cost are included. As examples of assets, we have rental income and remeasurements of investment property, interest income and fair value changes of financial assets such as debt securities. In the investing category, cash and cash equivalent income and expenses, and equity method applied associates and joint ventures, income and expenses from non-consolidated subsidiaries, associates and joint ventures are included. Income expense from investment in equity methods. Japanese stakeholders have given us a lot of input, and I would like to ask Suzuki-san to discuss what has been discussed and what are the key points that the Japanese stakeholders may want to know. Thank you very much. And thank you very much for your feedback. We were given diverse feedback, and we are highly appreciative of your feedback. We need to develop standards from different perspectives. In order to do that, we need diverse views. And points that are important and necessary for corporate organizations. Without us understanding those important points, a good standard cannot be developed. Therefore, I am very much appreciative that they have given us extensive feedback and the discussions that we have had with the stakeholders. Not limited to this case, accounting using equity method, income expense from associates and joint ventures. We had 15 deliberations on just one topic. 15 sessions we had. I think it was an extraordinary that we had 15 sessions on this particular topic. So the positioning of this income and expense item was very critical. Investing using equity method, what is the significance in terms of operations and business? I am fully aware of the importance of working more than 20 years as a certified accountant, public accountant in this country. So I'm very much aware of the importance of the accounting for equity method entities. Investing using equity method. There are companies abroad that have a similar approach to approaches taken by Japanese companies. Meanwhile, there are companies that believe this is just a part of an investment. Initially, when we published an exposure draft, whether it's separable or inseparable or to the main business, whether the investment is inseparable with the main business, whether integral or not, application guidance was included as a part of the exposure draft, whether investing is integral or to the main business or not. But the image of integral and non-integral that you have may not be the same as our understanding, and integral and non-integral decision could be very subjective, and it could be difficult to apply. There was almost no support on the part of companies and investors. theoretically, these two categories should exist in terms of the management's view for the equity method entities, and we fully understand that through our communications with our stakeholders. Meanwhile, the strong request from investors was that equity method investee is not treated lightly by those companies, but accounting for equity method could be after tax, and this could be a mixed bag of different items. Therefore, a separate analysis is being carried out on the ground in reality. So, equity method investment income and expense from equity method investment, normally that's analyzed separately from other income and expense. And after doing the analysis, you add them up to look at the performance of the group. That's how the analysis is done by an analyst. That is why they didn't want this to be a part of operating income and expense, and we had to pay respect to this way of thinking. That is why we came to a conclusion that this should not be a part of a operating profit. But the category of investing, we are not asking the labeling of investing on the financial statements. That's not what we are asking for. When defining operating income, what will be included in investing will have to be looked at. That is why the income expense from equity method investments should be outside of the operating profit and not financing, obviously. That is why this will naturally reside in investing category. That's how we look at. Meanwhile, from corporate management says that income expense from equity method investment plus operating income show the result of core business. We took note of that. That is why that subtotal is called a specified subtotal in the standard. Once it's included in this classification, although the subtotal is a part of NPM, the NPM requirements will not be required. So this is to lessen the burden. It is an exception. So for those Japanese companies which include income and expense from equity method on top of operating, I'm afraid that you may have to do some change, but should come below the operating income, not above the operating income, and you may have to come up with a new subtotal. But when you introduce a new subtotal, this will not be required to be disclosed as an NPM. This is our endeavor to lessen your burden, because the exemption will be available on the NPM side. So in introducing these subtotals, I believe we try to be receptive to your requests at the board, and this is the landing zone that we've come to a conclusion.
Vesta, how excited you are about this requirement?
I think lots of investors are excited. So Rika highlighted that we'd had extensive discussions at the board table over this issue, but the message from investors has been consistent and it's been strong throughout our deliberations of this issue. And again, as Rika highlighted, the key here is that irrespective of whether these are an important part of the story for investors, how important they are to companies, investors seek to value equity accounted associates and joint ventures separately from the rest of the business. And they do that for three key reasons. Firstly, that there's no contribution from revenue from these investments, and so inclusion of those in operating profit distorts an operating margin. Secondly, they want to see an operating profit number that's tied to the financial performance of controlled entities and assets, which is obviously doesn't include equity accounted associates and joint ventures. And thirdly, again, as Rika highlighted, the nature of this contribution is different in that it's post-tax and it's post-financing. And so just to have clarity and a consistent number that's included within operating profit, investors have asked that this should be outside of operating profit, and that means it ends up in the investing category. There's nowhere else for it to go. But we have sought to accommodate, as Rika has highlighted with the additional subtotal, that these are important investments, that they have profile within the structure of the P&L. But really, investors regard this as a very important part of what IFRS 18 is delivering to them. Again, coming to that first P&L puzzle, often the question is, where are the equity accounted associates and joint ventures? And now that they will know consistently where to find those.
Thank you. Then going into the financing category, and income and expenses from liabilities will go in there. Under IFRS 18, liabilities that arise from transactions that involve only the raising of finance and others, those would have to be distinguished. So these two types of liabilities, in order to classify what are exchanged in the transaction, will be looked at like a loan if the company receives cash, and if cash is going to be returned later, that would be only raising finance. On the other hand, like lease liabilities, the right to use is exchanged by cash, then that would be other liabilities. If it is only raising of finance, just like loans, borrowings, then recognition and derecognition increment will be included, and all income and expenses from liabilities will be classified. And then lease liabilities or defined benefit pension liabilities, then the interest rate and the foreign exchange impact, that part alone will go into this. And an example like other liabilities, it could be payment for the services or asset retirement obligation. And defined benefit liabilities, what goes into financial category, the defined benefit liability and its net income, and the interest payment or the interest income. So what goes into financing is liabilities. If the pension is an asset, it will go into financing category. The next is requirement for specific companies. And what is specific companies? Like investment property companies, insurance companies, financial institutions. For these companies, the classification that we just explained, the income and expense that goes into the important margin, it will go into investing or financing category. And the important performance numbers would not go into operating. So these are separate requirements for specific companies. And this is an example of banking, of investment banks or insurers, and an example of a statement of profit or loss. In the case of an insurance company, there is the financial gains or losses that can now go into the operating category. In the case of financial statement, not in the financing, but in the operating, the interest expense in order to place it into operating category, the net interest revenue can go into operating instead of financing. So the interest revenue from liabilities can come here. For financial institutions like a bank, the operating profit is shown here, and the profit before financing and income tax, most of the interest goes into operating, and if this subtotal is shown, it could be misleading, so the subtotal would not be presented. And next is the management defined performance measures. Again, we would like to ask you a Slido question. Does your company or your client, you might be a preparer, or if you have a client, does your company or your client use alternative performance measures in the communication with stakeholders? So this is a kind of a questionnaire. So would you please respond?
Nick, is there anything you'd like to say about the results?
I mean, it's interesting how extensive the use is, I think. And what we look at here, about 2/3, I would say, saying yes there. So I think it underlines the importance that investors put on these measures. Investors do value these measures. Companies be able to tell their own story. And in a moment, we'll talk about the enhancements that we are seeking to bring, or that IFRS 18 will bring, about greater transparency around the use of the measures, which I think will, again, enhance the value of those measures for investors.
What goes into IFRS 18? It's not about all MPMs, but the next question, out of those, what would actually be included in the scope of the MPMs? Which of these following would constitute MPM? Row 1, adjusted net profit. Indeed, very interesting. The alternative performance measures. I understood once again how widely APMs are used also here in Japan. And then coming to this question, if they do not constitute MPMs, after all, there are many other alternatives that might be used. So the adjusted net profit, many respond in this way. And the MPMs, it is the subtotal of incomes and expenses, and what does not meet the definition would not be included, and the operating profit that is required, that would not be included. So a certain adjusted item, to include that in the net profit, or even if operating profit is shown, if it is adjusted operating profit, those might be used in the financial statement. As for the question, which of the following are in the scope of MPM was the question, and that is my observation. And this question is, will a subtotal of income and expense prepared in accordance with JGAAP be an MPM?
I think all the answers are in. 75, you're correct. It depends on the facts and circumstances. That's the correct answer. But before we explain briefly the definition of MPM, there is We need to go back one page. These are the 3 key points in defining NPMs. It has to be subtotals of income and expenses. Second, it has to be included in public communications outside financial statements. And thirdly, measures that communicates management's view of a company's financial performance. Those are the requirements for an NPM. Whether a subtotal of income and expense that is prepared in accordance with Japanese GAAP be an NPM, I would like to invite Suzuki-san to explain. I know this question was rather difficult for you to respond. That's my guess. If you apply the definition per se, subtotal of income and expenses that is prepared in accordance with Japanese GAAP, with reconciliation, could go back to IFRS number in a way. So if you look at this seriously, if you are using this pervasively, the subtotal of income and expenses that is prepared in accordance with Japanese GAAP will be an NPM. So when we published the exposure draft, a lot of concerns and anxieties were expressed by the Japanese stakeholders. I was, but using the number under the JGAAP, including that in a disclosure document, if you need to do reconciliation, IFRS P&L and JGAAP P&L, it's a reconciliation between 2 sets of standards. During the transition period, you had to produce the reconciliation in transition to IFRS. Am I expected to produce the same reconciliation every year? That was a concern. Whether that is an information which investors want, I wasn't sure whether that is exactly the information that investors wanted. Nick Anderson and other board members, ISB members with the background of investors, whether that's what the ultimate goal in terms of the practice with the NPMs. We had some conversation, and I personally did an outreach to those ISB members who had investor background, asset management background. You are assuming that there are numbers available under the JGAAP. We are not assuming JGAAP numbers that are available in conducting our NPM discussions. When ISB has had this discussion on NPMs, IFRS financial standards are being used by the corporations to produce financial statements, and the measures are used to facilitate communications with the wider public. That was the assumption, the basis of our deliberations at the IASB. Based on that assumption, what should be a part of financial statements to enhance transparency? That was how we approached the NPM deliberations at the IASB. That was exactly the purpose of introducing NPMs. The content of the corporate management communications should be a part of IFRS's financial statements that will be outside of the objective of what IASB was trying to accomplish. Our objective was not to introduce the practice from abroad, so we try to eliminate as much as possible the practice outside in different countries, because Nick and other members with investment background. There are performance measures, many of them within corporate organizations, but what investors would really want to know is what are the measures that the corporate management is using to facilitate communication with investors. It's not a list of numbers that investors want. They want to know what measures and indicators being used by the management to communicate with the public. And I know that this will be discussed in more detail later on, but by rebuttal, if it satisfies the definition of MPM, if there is a rebuttal, you can overturn. That is the mechanism that we have put in place. So if you have measures based on JGAP, and if you are using this measure to facilitate communications, for example, for the investor relations purposes, then we have a fact that you are conducting the communication with the measure based on that fact. Financial statements based on IFRS and the measure used for communication with investors is not for the purpose of having a discussion based on IFRS. That is why we have the rebuttal mechanism available for you. And that is one of the ways that we have tried to dispel the concerns on the part of Japanese stakeholders. Thank you. The management defined MPMs, the management defined performance measures. There is a requirement that this has to be disclosed in a single note. And the important thing is that the reconciliation back to IFRS defined subtotal in the next slide shows an example. Not just the reconciliation items, but a tax effect and impact on NCR should also be disclosed. As Suzuki-san mentioned, NPM has to show the view of the management. This measure is used for what purpose? To communicate what to the investors? What aspect of the performance? What information is being conveyed? That also has to be disclosed. NPM could be newly introduced, could be eliminated, but change to the NPM will also have to be explained. And this shows an example of a reconciliation. This is just an extract which is on the screen. And this shows two NPMs as examples. Operating profit, adjusted operating profit, and profit from continuing operations, adjusted profit from continuing operation. Those are the reconciliations that we are showing on the slide. This is in a tabular format. Tax effect. And NCI. Impact on NCI. This was based on the request by investors.
Of course. So what you see on the screen now is as Ryan says, is a reconciliation between the IFRS measure and the MPM. And this reconciliation of this format is provided by some companies today, and it's certainly been warmly welcomed by investors. And it allows them to see the impact of the adjustments to reach MPMs, how those feed through as you work down the P&L. And that helps them in a couple of respects. So first of all, understanding the tax effect in aggregate allows investors to take the MPM number and see how that would be replayed in terms of an earnings per share number. I need both actually the tax and the NCI effect of the MPM adjustments to get to that earnings per share number. But investors also want to go one step further than that. Now, that, as I mentioned before, they value these numbers, but they also want to analyze these numbers. Ultimately, they're seeking to get to a measure of sustainable recurring profit as the basis of their forecast for going forward. So they will cast judgments in terms of the individual adjusting items, whether they believe those are actually one-off adjustments, in which case they will be prepared to accommodate those within their view of an adjusted number, or whether some of these are regular in nature. So if restructuring expenses, just for example, happens to be a very regular adjustment for a particular company's NPM year in, year out, investors will be inclined not to give the company the benefit of that adjustment. And so they actually want to go one step further and decide which of these categories that they will accept as the adjustment to NPMs and which they don't, as they work up their own adjusted version of the numbers. And in that respect, you need to have both the tax and NCI number to do that. Now, we've also been cognizant of the cost of providing this information, and I think it's fair to say that investors want to have a broad understanding of the tax effect rather than necessarily understanding whether a particular item attracts a tax charge of 22.5 or 22.6. So here again, we've sought to provide some cost relief in terms of thinking about how those tax effects can be worked up.
Thank you.
And the next question. To calculate the tax effect, it could be expensive. That was referred to by Nick. And therefore, which method can a company use to calculate the tax effect on adjusting items in the NPM reconciliation? You have answered all of the above.
Rika, is there anything you'd like to say about the tax?
Thank you. This is difficult. As for myself, the correct tax information and collecting it, it's very difficult. It is expected that collecting information related to tax effect is not easy. So the corporate members, auditors, everybody said it's going to be very hard, and I had to strongly respond, yes, you are right, it is going to be very hard and difficult. That was the kind of exchanges that we had. And as we speak to investors, and Nick briefly referred to this, members of the company or the auditors, can they provide precise, perfectly accurate information? That is not what is asked. And then qualitative information would do, I sometimes thought at one point. But for the reconciled adjusted item, the tax could be different. And therefore, if it is only qualitative information, it is not sufficiently useful. That was the feedback. And then, what could be done? Multiple methods were made available because perfectly accurate, precise numbers are difficult, and we wanted to show that we recognize that aspect, and therefore in practice, to make it practically possible for companies to collect the information related to tax effect, what the companies think is reasonable enough to present. We wanted to show that there is flexibility and companies can combine multiple methods, information from a large subsidiary and information of the parent company. That might be quite accurate, but when it comes to tiny, small subsidiaries, even if you demand a very precise number, they may not be a material information, and it may not give useful information, and spending excess cost on that aspect, that we thought should be avoided, and therefore including a mixture of different methods, appropriate flexible methods. These were the sort of middle point, landing point. That I think is the background. Thank you. Next is about the grouping, like aggregation and disaggregation. And again, starting with this leader question. So does IFRS 80 require companies to present all material information separately in the primary financial statement. Means that responses have come back no, 104, and yes, 38. And before explaining, may I ask the next question as well? What is the new concept introduced by IFRS 18? So whether it should be presented in the primary financial statement, and what is that new concept? Similar number of responses, useful structured summary, most of you have chosen. And indeed, it is useful structured summary. Under IFRS 18, what is new? The role of the primary financial statement and the role of the note have been defined. And in terms of the role of the primary financial statement and a new concept, useful structured summary, has been included. What comes into the financial statement? Of course, they are naturally all material, but presenting all of the material information in the primary financial statement, it would be too busy, and therefore, as a higher level concept, useful structured summary has been introduced. Ms. Suzuki, can you talk about this useful structured summary or about materiality briefly? Thank you. Yes, we call it a new concept, but in reality, I think already in your practice, I'm sure that you have been sort of applying this. What should be presented in the primary financial statement when you have made your decision? I am sure that you have already been doing, and I think our new concept just followed what you are doing in practice already. Naturally, of course, you think that there are many informations that are material, and that has to be presented in the primary financial statement. But when you select the line items, if you just present all the information you think is material, then there will be just a tremendous number of line items. Therefore, naturally, companies have thought hard to come up with your financial statement, and in alignment with what you're already doing, I think the board has made the terminology useful structured summary. After applying IFRS, if some years have passed after your first adoption, your corporate environment might have changed, and your businesses might also have changed after you first adopted IFRS, and therefore, to review the line item of the financial statement, it's not easy to change. Therefore, at the opportunity of IFRS 18, maybe this is an opportunity for you to review once again your line items, and if you think changes are necessary, you can take this opportunity of IFRS 18 and sort of review and reorganize your line items again. I think that would be a useful opportunity. And even prior to that, you might be forced to change. If there are material situations, of course, you can go ahead and change your line items. But once again, this could be a trigger for you to review.
Package with useful and structured is general principle on aggregation and disaggregation and information labeling. They come as a package. The aggregation will be done based on shared characteristics, and disaggregation will be based on non-shared characteristics as a result of disaggregation, whether information produced is material the single dissimilar characteristics can be enough to disaggregate if resulting information is material. I know that Nick referred to this, and I know Rika has also referred to this, but labeling could be an issue. Other liability presented on a primary financial statement and disaggregation of that disclosed in notes. That's being done, but there the amount for others could be quite significant. The labeling of others, I mean, how to use meaningful labels. If you must use other, then what kind of information should be disclosed? Those are included. Operating expense, presentation disclosure, a requirement. There is. And let me move on to CEDO polling. Operating expense, whether it's by function or by nature or mixed presentation. Almost all of you are correct. A mixed presentation is permitted. Suzuki-san? In the IS1, basically for operating expense, it's either by function or by nature. Mixture of those two, in principle, is not permitted under IS1. But as a matter of reality, practice, in order to satisfy that requirement under IS1, there has been allocation, rather artificial. That has been a drawback in terms of practice that I hear. And to avoid that, in some cases we have a mix. So that has been an issue. And ISB thought that there is a need for us to address that issue. By function can be used for lining them up, but there are by nature case, for example, goodwill impairment is a good example. By function, allocation to different departments is not being done. So artificially allocating to different departments may not necessarily be the best communication of performance, because that's not what the management is doing. And that kind of contradiction is something that we try to address by IFRS 18. That is why we have a requirement which will result in the yes answer. In reality, some companies have to disclose by nature disclosure. So which companies, what kind of companies have to disclose by nature? Companies that present one or more line item comprising expenses in the operating category by function are required to disclose specific expenses by nature. Now, let me ask you, Nick. Disclosure of expenses by nature is where we had a lot of feedback from companies. We've taken into consideration their feedback in developing this disclosure requirement.
Board landed where it landed.
Thanks, Rowan. Yes, we had a lot of strong feedback both from companies and from investors on this issue. Investors told us they found information about expenses by nature very helpful in their analysis. Often they found those numbers more intuitive to use and clearly easier to relate to the cash flow statement when using the indirect method. But what we heard from preparers was that this information could be difficult to provide with sufficient detail. And it really depended in terms of how their operating systems were currently configured. And I think we got to a place where we wanted to pursue the original requirement, which was for a complete disclosure by nature, where you report by function for the whole P&L. That would have extended the life of the project by years, I suspect, and certainly the implementation period would have been extended. So the board has sought to find a compromise which appropriately weighed up costs and benefits, and as a result of that, we landed on requiring 5 by nature expenses to be disclosed, and those are depreciation, amortization, employee expenses, together with specified impairments and write-down of inventories. Now, the requirement is slightly different in that those will have to be disclosed in terms of which line item they fit into, in terms of your by function presentation. So not only does it provide information to investors on those particular expenses, it also builds stronger linkage between this information and what's shown within the primary financial statement. So I think that's an additional positive for investors in terms of how we could persuade them that this would be a more appropriate route to go down in terms of actually balancing the costs of the information with the benefits. So this has been a long journey to get to where we've got to today, but I think we have landed in an appropriate place.
Thanks very much, Nick.
The amount disclosed, inventory, capitalized amount can be included. That's the rule. Suzuki-san, ISBs. What was the consideration part of ISB there? Right. The 5 items, we narrowed down to 5. That's one point. But you have to gather for these 5. That's the question. Consolidated financial statements, the recognized numbers within that 5 items, disaggregating into 5 items, whether all companies can be or should be required. This still is a question remaining even after we narrow down to 5 items. Depending on accounting system, the recognized amount, it's a by function information, but there may be systems which can disaggregate by nature. A statutory requirement, that is, in some jurisdictions and in some markets. So it's not impossible to translate from by nation to by function. But if you have an environment where that has not been a requirement, to what extent you can achieve with introducing a new system, IS 1 to IFRS 18, taking into consideration the importance of transition, priority of transition, that was a hurdle that we had to overcome. The final number, which has been recognized, disaggregating this final number, depends on the system that the company uses and the subsidiaries, the system that you use to gather information from subsidiaries and other entities. The system may not allow that. If you were to do that, the cost could be prohibitive. So we know that. So the amount at inception, depreciation, in the case of depreciation, fixed PP&E, increase, decrease table, the number can be linked to these numbers on the table. And I know that these are the numbers that are being gathered by companies in some way or the other, and these numbers can be linked to the disclosure, the numbers to be disclosed. And that is why we left that route open. That's the background.
Thank you. Due to the time, we can't talk much, but there is some changes due to the statement of cash flow.
In closing?
So I guess, again, fantastic to see so many of you here today. I think this represents a significant change for both investors and preparers. And although the 1st of January 2027 may seem a way ahead, now is the time to start thinking about implementation and getting organised for implementation. And we hope as an organisation we can continue to support you on that journey. So thank you.
Once again, thank you for giving us this opportunity. Just as Nick mentioned, this is the time for you to start your preparation. Of course, there is the OECD project, and you also have to disclose sustainability-related matters. Apart from the financial reporting, there are so many activities ongoing, and you have to respond to so many requirements. But when you plan your timetable, please do keep in mind that you want to act under IFRS 18. If you start earlier, that would ensure more smooth transition for your entire group, we believe, and therefore we really encourage you to start your action now. Thank you for this opportunity. We stand by with you for your smooth transition. As Nick has mentioned, we will do whatever we can. Thank you. Rowan? Thank you very much to all the panelists. We would like to express our gratitude.
Thank you. Please step down from the stage. We would like to move on to closing remarks. I would like to call upon Mr. Tetsuya Mogi, Chair and President, Chairperson and President of the GICPA, to take the floor. Over to you. Well, again, thank you for having joined us for the ISB seminar, co-hosted by the FASF and JICPA. We've heard 2 lectures and a workshop with ISB members, Mr. Nick Anderson, Ms. Rika Suzuki, and Ms. Rohan Hasegawa, ISB technical staff. Thank you very much for joining us, and we had an insightful presentations and a workshop. I think this has been quite informative and useful for us all. Thank you. JICPA will continue to work with the FASF to organize seminars and other events during which we can directly hear from those directly involved in developing IFRSs. I believe these seminars and events are very much important, and I hope you will all join us for future events through different opportunities, including seminars. JICPA is committed to share information with our members and the community at large. I would very much like to hear your input and request for topics that we should take up. Please do not hesitate to contact us and give us your request. In concluding, I would like to once again thank you for your participation and hope this seminar will be useful in your day-to-day practice. And I ask for your continued support to both the JICPA and the FASF. So on behalf of the host, I just wanted to give you a concluding remarks. So thank you once again. Thank you. That was Mr. Mugi, Chairperson and President of the JICPA. With that, we would like to conclude the IASB seminar, IFRS 18, Financial Statements, a Presentation and Disclosure. I thank you very much for staying with us.